Hi, I'm Jordan Quijano, and I want to welcome you back to our channel with Become the Banker. Today's topic is truly a great one, which is OPM, other people's money. I don't know if you've heard of this topic, but it's how you can make your money continue to work for you while you use other people's money for buying cars, using loans, or anything else of that sort. And this is exactly what Become the Banker is about. Now, I'm gonna take to the board here, and this is truly what the wealthy have used for many years, keeping their money always earning interest, but using banks' money, using our money, using anybody else's money to pay for their purchases. So how does this work? I want to take in a line here, just for a couple purposes here. One of the main points is when you look at our hard-earned money, we get paid monthly, 2 times a month, and our money gets deposited right into our bank account. Now, in today's world, truly, we have what I call a bucket of cash, whether it's at the bank earning 1% if you're lucky, 0.5%, and we get taxed on that. This here is what I call the $0 line. Well, most of us, unfortunately, go in debt. We pay on credit cards, borrow the money to pay for our vacations, and it takes maybe 2-3 years to pay that off and get right back to even. Now, unfortunately, this circle of people, how we get stuck in this, is what we call debtors. This is very easy to get stuck in this because what happens is we borrow for the next purchase. Maybe it's a vehicle, maybe a house, wedding, whatever it is, we never get ahead of the $0 line. Never building any savings and never being able to access that money to really grow for us. Don't get stuck here. It's very difficult to get out of. Now, savers, on the other hand, this is the second line, and this is truly, I think, where most people are gonna sit, where you may take 3 or 4 years to build money, and basically, instead of borrowing money or using credit cards, what do savers do? Pay cash, and this might be hitting home to you. You end up draining some of your savings to bring that account back down. You get uncomfortable, start building it back up, and it's gonna go like this all over your life, where you have this up and down motion of your savings never consistently growing. It's like what we call the Great American Roller Coasters, or what economists call it. You're never growing your money because it's always going up, pay for the purchase of a car, up, pay for a house, up, a wedding, college, whatever it is, to again, nearly never build savings, never get it going forward. Now, what I want to take away from these two principles here is what I'm getting to today's topic. I will say there is a good principle with debtors, and that's what we're hitting on. OPM, other people's money. We want to use this to help get ahead while keeping our money earning interest. And that's where we don't want to be in the savers area. But the savers principle is paying yourself first. You have to pay yourself first. There's too many times that we get, again, that paycheck that comes right into our bank account. We don't even see it anymore. And what do? We write a check out to our mortgage, electricity, vehicle, to leave nothing at the end of the month. We have to get into a position of when we get that check, we set money aside first by paying yourself first, 10%, 20%, and then start paying out the debtors, the bills. If we get stuck in this, I have to say it, I hate to say it, but this is truly economic slavery. We're not making any money. We're working for free if we're giving all the money away. So these two principles, other people's money and paying yourself first. What does that deal with us? Well, truly, this is where Become the Banker and the infinite banking concept comes in place. You're able to still build your money every single month. As you pay into it, your cash builds up. But when you want to borrow the money and use this money to purchase it, we want to take into account OPM. Your money is not going to go down like it has done for many, many years. Instead, we're going to use the insurance company's money to lend it to you. This is how good this is. Using the policy with Become the Banker, it's a life insurance policy that deals with not just regular whole life, but a very cash aggressive whole life. Not all whole lives can do this. You pay into it with your contribution every single month, every single year, and the cash is going to continue to grow. Close to about 5% maybe, depending on what companies deal with. There's 6%. It just matters with who you work with, and we can help you find those companies that fit your needs. But we'll keep it to 5 to 6% today's example. This money's always consistently earning, compounding, it's snowballing, getting bigger, bigger, and bigger. But like I mentioned, we don't want to just let that sit there and not use it. This is why today's concept with Become the Banker is so important. It's not like a 401k that you have to wait until retirement. This is meant to be used today. We are going to use the life insurance company's money here, and this is the OPM. So as we build this up, let's say you've got $10,000 built up inside there that you've saved over all the years by stacking it up and earning interest. Well, we might have a $5,000 purchase that we want to make. Maybe it's a credit card, maybe a vacation new water heater. Savings, if this was a savings account, we already know where this would go. You take it out of your savings, now you're dropped down to 5. But more importantly, you lost the earning potential of the full 10. Lost opportunity cost. What would that money have done for you forever, even if it was earning 1% at the bank? You're losing interest. Well, here, the insurance company knows you're good for the money. Why? You've got the $10,000 sitting with them in your policy. Like I said, earning 5 to 6%. And it's life insurance, don't forget. There's also a death benefit. Let's just say it's $100,000, again, for simple terms in today. So they know if you had to cancel and cash out, you take 5, they cancel the policy, well, they can give you the other 5. They're good on that side, minus the interest, of course. Or if you passed away, what would they do? Take the 5 off 100, pay out 95 to your loved ones. So they know it's a secured loan, it's backed. Those are the 2 biggest risks that banks are fearful of, or lenders are fearful of, is if you pass away or can't pay on the purchase. They're gonna give it out of their pocket, lend it to you. You're earning compound, as I mentioned, interest, but guess what? They're lending it at simple interest. Now most people, let me just take a second here, don't even realize how important that statement is. You're earning compound interest, but paying simple interest. Why is this important? Look at your credit card statements right now. Perfect example, your mortgage, any of them. Right now, when you make a payment toward those, you're paying towards compound interest. That's on a credit card or a mortgage. So you keep that credit card, pay the minimum payment over 2-3 years. Guess what? You're paying this much in interest when you only borrowed this much in money. That's because of compound interest working against you. Here, it's working for you. That means your money is going to grow, stack on top of itself, and keep on earning. But simple interest, on the other hand, this is important. In this case, it's 5% once a year. Not monthly, but once a year. So that's simple interest, call it $1,000. That'd be $50 for 1 full year at simple interest. And being that it's declining is the beautiful part, is it always resets on what the next year payment is. So if it's $1,000, 5%, you got borrowed at $50, and then you pay it down to $500 to the next year. Now it's only 5% on 500, which is $25. That's the point. I don't want to lose you in the numbers, but the point is, it's very minimal. It's minuscule versus the compound interest you're earning on your cash. So, getting back to this, OPM, your money's earning interest. We're borrowing money from somebody else, which is the insurance company. They're giving you the $5,000 out of their pocket, but guess what? This is the key. Your full $10,000, the full 10 is still working for you at the 5 or 6%. That's crucial. The full 10 is earning interest as if you never touched it versus you losing it at the bank if you were a saver. So OPM, folks, this is the important fact of today. You're gonna have many more purchases. Vehicles, like I said, family emergencies, home remodels, it doesn't matter, but there's gonna be many more purchases. So at the end of the day, instead of you losing interest, why don't you keep your money earning interest and use other people's money? Now, the last piece I want to leave you with, is there's more videos on this topic and how you can actually overfund it, pay yourself the extra interest that the credit card company is going to charge you, and so on and so forth. But that's something we'll share in a different video. And please give us a call and we'll go in more detail. So I'm Jordan Quijano with Become the Banker. Go ahead and click the link below to sign up at mymoneymyway.com for a one-on-one consultation. That'll be with myself or with my father, Joseph Quijano. And this is going to give you all the insight on how you can stay out of those debtor and saver positions and really become a wealth accumulator. Thank you so much. We'll see you soon.